Hello and welcome to another episode of the Swing Trader Weekly Status Update. It's Justin Nielsen here, your host, and we are coming to you live on March 4th, 2025. We've got a market that just keeps on trying, but hasn't really had a follow through. So we've been sitting in cash. And to help explain why, here's Mike Webster, our senior market strategist, who joins me pretty much every week. There he is. Okay, he's coming. So Mike, let's get into it a little bit. This has been a little bit of a rough market, and look, if you're in cash, I suppose it's not really that big of a deal. But let's go through it. I'll go ahead and share my screen right now, and you can walk us through the current action.
Yeah.
There we go. Okay.
What a beautiful chart.
Right. And look, just to kind of remind folks of one of a few of the things we've been talking about. Here's that December 18th, which is kind of when a lot of the chop started, and it really hasn't been easy since then.
Mm-hmm. Yeah, so that was a changing character in a big way, the December 18th, and that's why we talk about it all the time. That was when Powell came out and kind of changed his approach to how the Fed was going to be handling cuts. Now, things have kind of changed now, not from their standpoint, but more if you look at the Fed funds futures, the way they're looking at what the Fed is going to do, that's kind of all over the place because of weaker economic conditions and a lot of uncertainty out there with all the changes that are coming out of DC. So their hands are kind of getting, forced, into doing, at least the market believes they're going to do, a few cuts this year. And, not too long ago, there were going to be like hardly any or maybe one. And so that's all over the place. And that's is a big part of how the market looks at valuations. And that changes, whether the heat is moving or it's the slow pokey stuff, or it's the more, the dividend type of stocks or what have you. Oh, perfect. I'm glad that you went here. And let's scroll down so you can see like what it was a month ago, which is always interesting. So if you just focus in on that one number, the 12.1, so that what that is telling you is on 1 month ago on February 4th, the market thought that 12.1 there's a 12.1% chance that by December, because he's pointed in the December meeting, that there was going to be no change at all, because right now we're at 425 to 450 for the current Fed funds, but now that's changed to 2%. So just in one month, that has changed that much. But go to your May 7th one on there. So earlier today, I was looking at the current one where it's currently showing 60, and that was like 51.3. And I know that because I was waiting for it to get to 51.5, and I was going to tweet that out, and I got distracted. And so as it moved through there. So that's a big change just in one day's information. You got to remember that there's so many things. All these spreadsheets on Wall Street are, have this data item in there, or data items, related to the Fed funds futures for the rest of the year, put in their valuation models. And that changes a lot. And now let's go back to, or do you have anything to say about this? Because I mean, we could talk about this.
Right, exactly. I was almost afraid to bring it up because I knew it might distract. But yeah,
because we could go on. So when you see the interday charts and how wild they are, you also want to look there and see like, oh, lots of times they're wild because it's like, is it the tail wagging the dog or the other way around? It's really hard to know, but that's also why, Bill O'Neill, the founder of IBD, taught us to keep things as simple as possible rather than looking at what the bond market is doing or looking at what the Fed funds futures is doing or any of that. Just look at what the market is doing, because the thought process there is all of those things, and there's the dollar, there's, all the other currencies, there's what's crypto is doing, what other earnings are out there, what other news, global, news, macro news. So many things are going into all of the different ways people are pricing stocks. If you just keep it as simple as possible, just look at it on an index level. What is that doing? And what did we do today? We were down again, but we were all over the place. Let's go back to that intraday chart. Um, and it looks orderly here, but intraday doesn't feel like that. I mean, it was, we were down a whole bunch, and then we're just riding up, and it looks like, at that peak, it looked like a beautiful upside reversal, and then we just fall off a cliff. And this is what poor markets look like on an intraday basis. They will have these big swings that will get you sucked in. We almost put some stuff on SwingTrader. We could have today, but we sat on our hands because we really want to wait until we get some more clarity in the market, and we have a trend. And right now we're in Chopville. We're not in Trendville. So
Well, and to your point, Mike, I mean, one of the things we were also talking about in terms of a lot of price discovery is IBIT, the Bitcoin ETF. This iShares Bitcoin Trust has been all over the place this week, and it's only day two, starting with overnight, or over the weekend news, and that really sent it soaring. I'm just going to go start with the daily here. Sent it soaring, came right up to the 21-day moving average line, got turned away, was still positive yesterday, but it was up over 10%, and then closed just up a couple percent, and then today really down hard, and then kind of closed just up 1%. But yeah, you look at this move on the intraday, and it's all over the place.
Yeah, that essentially got to, what people refer to as a shakeout +3, or I refer to it as a shakeout plus, which how you would read that is you take that 50.69 and you add 5%, 5 to 10% on there, and that gets you like around 53 and a quarter. And where did we get to the high yesterday? Right around there in that ballpark.
53. Mm-hmm.
Yeah. So it was just shy of, 20 cents shy of triggering that. And that's not an exact pivot. It's just more of, a general area of a shakeout +5 to 10%. So it was right there, and then it backed away, and it really looked like it was going to go. I mean, that was over the weekend. I mean, man, that's all you heard about was what Bitcoin was doing. When, and even though we're not trading Bitcoin at this point, directly, lots of people are, and the same people that are trading the stocks that we like to trade are in there. And if you've got, something up 10% that fades and gives it all away, you're not as anxious to buy some other heat out there. So it tempers the just kind of the tone of the market when you got heat going up. And I would say, Bitcoin is certainly heat. That's good for all risk assets, or most risk assets. And then when it comes in, that's bad. It's more good for your slow, pokey, low ATR stocks, but your medium to high ATR stocks are going to kind of trend more or trade more in line with what Bitcoin is doing. And so, yeah, that price discovery over the last couple of days, that's telling you that there's no equilibrium. No one knows what Bitcoin is worth right now. Because if they did, it wouldn't be traveling from 53 down to 49 or 48 or wherever it got. Yeah, or how low did it get today?
Today it got down to 46.28.
Yeah. So in 24 hours, it goes from 53 down to that point, and then back up to 49. Like, nobody knows. And the same thing of, like, let's go over to SPY, which is your slower of these instruments that we're looking at, and that's all over the place as well. And that's when you want to kind of be like a turtle and go in your shell and just kind of let this stuff go by you. It's kind of like if you're a surfer, and you've got just got hit in a really big wave, and you're underwater and you don't know which way is up. You kind of just hanging down there a little bit, letting the turbulence go before you try to pop up to the surface. And the same thing, that's what we're doing with SwingTrader right now. We're trying to let all this mess go by us, and we will try. We will nibble, and we did the other day. Let's go to the NASDAQ, and we'll talk about why we did. On Friday, we had a classic upside reversal off your 200-day, and that's a big deal, like a really, really big deal, because your 200-day, which is your black line.
I'm just going to back up so we can see what it looked like on that day.
Sure. So even though we know now that this failed, if you gave me that trade, I would be buying this all day long, every day. And the only reason why I wouldn't is if I was just using complete hindsight, which is not something that I like to do. So if you're intellectually honest and unless you don't believe this type of setup, but a bounce off your 200-day upside reversal, you buy that, because if you're swing trading. Now, if you're position trading, you don't, because that's day one of follow through attempt, and you do nothing. You wait for your follow through. But if you're swing trading, you're taking that upside reversal, and that's what you should do. And that's what we did. And we put a few things on, and we would do it again. And now let's go out one day, and we had to back away, because this is what I would call an expectation breaker. And you, Charles, and myself came up with that term, expectation breaker, back when we were doing the market school. And it was something that we couldn't put into a computer to say, this is what an expectation breaker is, but you know it when you see it. And so we'll just walk through why this is an expectation breaker. So you had a clear expectation on Friday that we should have moved higher and really up towards your 21-day, which is your green line, at least a decent amount above 19,000. That would have been normal and natural, really kind of probably up to like Thursday's high. That should have happened yesterday, and it didn't. But at least why it wasn't a classic expectation breaker is because it did at least trade up higher than Friday's high for a little bit. And then we came down and we had an outside day, meaning we traded above and below Friday's high and low, and then closed pretty much at Friday's low and right at the 200-day. That's as bad as it gets. So you had kind of as a cookie cutter, easy setup on Friday, and as bad as it gets on Monday. And then you have today's action. Let's go to today. And midday, I mean, it was so hard to sit on our hands because we really wanted to put things on the list, especially with SPY. Let's go to SPY, because SPY was then bouncing off of its 200. And so we were wanting to go in there, and when it was at its high and it was a blue bar, and it looked like really we wanted to bounce, but we wanted to just sit and give it a little bit more time. And of course, we ended up fading. Now, tomorrow we could rip. We'll have to see how tonight's news flow ends up going and how the market interprets things. But what is the closing range on this one? Did we even
for
get to 50?
SPY? Well, you know what? I'll give you some closing ranges just real quick.
Sure.
So for S&P 500, this isn't updating. Let me see. Let me try it over here. Yeah, so for SPY,
Just
35%, looks
okay.
like.
So 40 or higher would have been okay. Really, 50 or higher is what we would have wanted for a pink rally day, meaning today being day one of a new attempted rally. And that doesn't
For the
look
NASDAQ, it was about 52%.
Really? Wow, it doesn't even look like it, but looks more like a 45, but optical illusion sometimes. So then that's technically, if that's over 50, then that is a pink rally day, meaning that is day one of your attempted rally. So on day 4 or after, if we hold today's low, then that could be a follow through. So today's day 1, 2, 3, 4. So what is that? Friday then, right? Could be day 4.
Right. Mm-hmm.
So before then, if you're trading from an orthodox standpoint, you're sitting on your hands. Now with swing trading, you can.
And I just want to go over that real quick again,
Yeah,
Mike, because
yeah.
not everyone is familiar with the follow through day
Oh,
concept. The
sure.
idea
Yeah,
is
go ahead.
that after you're coming in, you're waiting for a rally day, and we do count a day that's normally just a day that's up. Again, if we just say any day that's up, no matter how it closes, whatever, that's a rally day. But we also do include these pink rally days that we call when you do close in the upper half of the range on a day where you're down. So that's why you're counting this as day one. And so once you have that day one rally, you're just counting until you get to day four. So Tuesday's day one, Wednesday's day two, Thursday's day three, Friday's day four, and then you start looking for your follow through day. That's the confirmation that the rally is not only holding up, but is actually getting strength. And you look for a day of power, ideally with volume heavier than the day before. Although I don't want to start that can of worms with you, Webby. But that's the kind of classic definition. And it doesn't have to be on the fourth day. It could be the fourth, fifth, 18th, 22nd day. But you get that confirmation, and that's when you start, buying. When you get the confirmation that the rally is changed its trend.
Well said. So with all of that in mind, we're really waiting, and look at these spreads on the days ever since we broke the 50-day. They're wide and they're all over the place, and that's not a sign that the market is comfortable with any level. And really, since December 18th, it's been wide and choppy. Now, we were able to get some traction during little periods in there because we were trending above the 21 for little pockets of time. And I know in hindsight, it looks like, oh, well, since December 18th, why didn't you just sit in cash the whole time? Well, you know what? You got to be intellectually honest and go back. And we don't have to do that right now, but you go back and you change the date on some of those days. And if you were sitting in cash, you're just silly, because there were opportunities out there. Now, you could always wait until you're at fresh highs every time. But then at that point, lots of people will say, oh, well, now we're sticking straight up. We need to wait for things to pull back in. And then they pull back in and people don't like them. So you trade the market you have in front of you. And right now, the market we have in front of us is not one that we like.
And as a reminder, I mean, we did have what we called the follow through day we didn't need on this day right here, because we had this pink rally day as day one, day two, day three, day four. On day five here, we were up, up significantly, up 1.5%. Volume was heavier than the previous day. And, there was a justification for getting back in.
And the
If
low
you
was
were
above the
out.
21 day. Like, you've got to buy that. Like,
Yeah. So as you said, there were a lot of, again, as you're going through it day by day, a lot of things where you would have said, yeah, this is something that is worth taking a shot at.
Yeah. And then the other thing that you do is you look to see what merchandise is there to buy. That's another part of the methodology is, are there things in position for your style of trading? This show is about swing trading, and are there swing trading setups? And frankly, there are some right now. And we could have taken a shot on a few, but we're just erring on the side of being cautious because bear markets, which this could turn into, they start off like this. You never know. There's not a signpost ahead of time going, oh, by the way, this is only an intermediate correction. Don't worry about it. This is a run of the mill intermediate correction. Will be done in 15 days, 10% down. You don't know that. Every bear market starts off looking like this, then it gets uglier and uglier and uglier. And before you know, you're like, wow, why was I trading during that? So we want a little bit
Well,
of
and just real quick, Mike. One of the things we were talking about is that okay, when things kind of get wild like this, there's a lot of price discovery. Sometimes we'll maybe gravitate towards some of the lower ATR stocks. ATR being average true range kind of tells you how much on a daily basis something averages in terms of its movement from highs to lows. And in the case of gaps, we'll use the previous day's close. So we were kind of looking at a lot of, lower ATR stocks. And I mean, some of those did not look great today.
Yeah,
MasterCard, which I mean, we took this off yesterday, not because it was doing anything wrong, but just because of how bad the market was. And, it's an ATR of like 1.5. So this was down more than 2 ATRs today. You had,
That's huge. Like for people who don't know in ATR terms, that's a big move. A 2 ATR is a big move.
and look at AT&T. AT&T, 1.79 ATR, down 5.4%. That's, and it looked fine yesterday. You would never look at this and say, oh, well, obviously this has got to come in, 5%. RTX, that also has an ATR of 2. It was down almost 4%, so almost 2 ATRs for that one. Fiserv, also just above 2, so it's 2.13 on the ATR side. This was down 5.8%. And again, you look at it yesterday, I can't find a fault with that. Everything looks fine. So yeah, TradeWeb was another one that we took off yesterday for a profit. Now, sure, it reversed as it was kind of coming up to this old high, but there's another one where this is a 2.5, 2.6 ATR that was down, just 1 ATR, but still a lot of damage done in some of the lower ATR stocks. So not really a safe place for anywhere on the growth side.
No, there really isn't. And when the market is like this, what happens is there will be some that work out, and then your mind will play tricks on you because you'll see the ones that you almost bought that you were looking at that end up working out. Let's look at what was the one Take Two that we were going to look at?
Yeah.
So this is one that we could have easily put on today. It was a share. I mean, I love this setup. You have a gap up on earnings. You hold in sideways. You have a shakeout underneath your 21-day with an upside reversal. That looks like cookie cutter classic setup with today's low as your stop.
Relative
And
strength, just moving up.
it has everything going for it. I'm kind of surprised I didn't buy it in my own account. But it looks really good. But what you want is a bunch of these to end up working out, and then you go, okay, it's sunny again outside. We can start playing. So what you do is you watch a bunch of these setups, and you see, are they sticking and acting the way they should? So what this one, is up in after hours, but a lot of things that look like they're up in after hours. So that's not telling you anything. But is this able to move higher and go above 218.75 and continue higher? That would be normal and natural with this setup. And what I would suggest people do is they screen a bunch, put a bunch of these stocks in that look like this, that look good. There was another one, I think it was FTNT.
Yeah, FTNT.
Well, I guess that didn't look as good. It looked better when it was blue on the day, but
Cloudflare. I mean,
yeah, Cloudflare. Yeah,
Mhm.
nice support at the 50-day. It's come in a little bit more than you would have wanted to, especially underneath the 21. But then again, in this market environment, it's a little bit forgivable. And that looks good. And we could have taken a shot on that one. What we want to do is be regretting that, like 2 days from now, just being going, man, we really should have taken those shots. And that's fine. Then at that point, we will start, regardless of what the market's doing. If we see a lot of setups that are working, and even if the market is chopping around, we'll start putting our toes back in the water like we did the other day. We put them in for a little bit and then took them right back out just because it wasn't safe. We needed a bigger boat.
A few others just to kind of round out the discussion. I want to circle back to Berkshire Hathaway because here we have another stock. The financials were looking so good, and this came in pretty hard. We also had this on SwingTrader, but backed away as yesterday as we were backing away on a lot of things just because of the market. Also, kind of in the setup side, Alibaba. Holding up fairly well. We got all these little ants in here. Ants are kind of an indicator of strength, but we are holding up. I mean, above the 21-day moving average line. And then
I
also,
think that one looks great, but you have a bunch of risk involved
Yeah.
with China right now, and we don't know if that's going to get better or worse. But as far as a stock, man, that looks really good.
Yeah. And then let's see, I'm just going to look real quick and see what BABA is in terms of its ATR. Looks like that's a 5.57. So a little bit higher on the ATR side. And so you would have to be careful of that. And then also one of the stocks we were looking at holding up fairly well is Netflix. I do still have a position that I've had for a while in here. I mean, this is getting support right there at its 50-day moving average line.
Yeah, it looks really good. And if that takes out yesterday's high, we'll probably put it on regardless of what the market's doing, because that would be a lot of strength. And let's take a look at Spotify, another one that we tend to circle back to in that same space.
Hmm.
And again, a nice upside reversal there. Yes, it's still under 600 and still under the 21 day, but it made, an attempt today, and you have that low at your 21 day, or your low of today, that is your stop, and you just hope that it gets back above that 21 day. But so there's merchandise out there to buy, and if we feel that the weather is getting a little bit better, we'll start doing that. But for now, it makes sense to be sitting in cash. As you
Yeah.
said, cash is king, and I also said BB's king, Freddie's king, Marcus is
Elvis. Yeah.
king, and Elvis.
So this is a quick look at the pie chart from last week. So a week ago, I mean, we did have a very large cash position. We were spread out in a number of different areas, but 60% cash. And here's our cash position right now: one big dot of 100% cash. But also, I think it's worth mentioning that one of the reasons why we have been cautious is that, and by the way, I just have to explain real quick. We have been doing a 50-day rolling, but Dominic and I, we man, sometimes our spreadsheet, it was so large, it was getting a little slow. So we did some cleaning. Dominic did clean house a little, and so we just went to year to date for now. Made the spreadsheet so much faster. So we're at like 45 days right now. But what's really important is we still have this 10-day moving average line on our equity curve, and we broke that pretty sharply. And that really kind of, as you can see, really put us in a lot more defensive mode. We've been, we've been getting up there, sometimes intraday, but then we, quickly back away. So we're still above our 21 day, but that's kind of rolled over. Our 10 days rolled over, where our equity curve is below the 10 day. We were starting to get up there, here, and we could easily see getting back above there if there was a follow through day or something. But while this is, below the 10 day, again, this is our equity curve, our performance. And I just have it indexed to 100, both SPY and our equity curve indexed to 100 as of the beginning of the year. But that's another reason why we've been cautious. And you can see that reflected here in our percent invested that has been very low lately. And then also one other thing, or did you have anything to add on this before?
Yeah, I think people should try to do this on their own account and pick the moving average that makes sense for you, for your style. Maybe you're a blend of swing and position. Um, but at 10 days is a fair place to start the yellow thing. So when you're above it, you're pushing it. And you think of it in terms of, like, if you're playing poker and you've got a bunch of chips, you've got a bunch of chips in front of you if you're above your 10 and your 21 day moving average. And that blue one is your 21 day of our equity curve. I know it looks like it's of the black line, which is the S&P, but it's
Yeah.
really of our equity curve. And so when you're above them, you've got those chips to spend, and you can push it and you can take risk. When you're underneath it, then you can't, and you're more short stack. Now, if we're underneath both of them, we'd have to be even more conservative. But what we're trying to do is be conservative now when we're not forced to, and it's better to start going slower, like we are now, which you can see with that green wall just fell down. I mean, we were on margin and we went straight to cash, and then we tried a couple times and then backed away. And we weren't even in that deep, really. And even though let's say we were in 30, 40%, we weren't doing it in an aggressive way. So you could be
Yeah.
30 or 40% in a very aggressive way, or you could be 150% in very conservative stuff. But we
A
were
lot of
doing it.
our exposure was with ETFs,
Yeah.
lower ATR stocks. So yeah.
Yeah, like the ones you brought up,
Right.
the Master and
MasterCard,
the
Tradeweb,
Berkshire. Like, I mean, when you're
Berkshire.
buying Berkshire Hathaway, you're not gonna play there. You're not swinging for the fences, man. So, let's go to our relative strength line once
Well,
again.
I was going to say,
Oh,
you mentioned how being under the 10-day moving average line, you don't have as many chips, you're a little short stacked, but on the other hand, relative strength wise, because we went to cash, here's our relative strength line versus the S&P 500, and there are some moving average lines on this as well, a 10-day in yellow and a 21-day in blue. So yeah, we do have relative strength versus the S&P 500 because we've been light as the S&P 500. You can see we've kind of just flattened out here, and that's led to a nice outperformance, for now on SwingTrader.
exactly. And I would suggest doing this for your own account as well. And you can do an or statement. You can be like we could rationalize, but rationalize sounds bad. You can make a logical argument for pushing it right now because our RS is going through the roof. But then you have to ask, why is your RS going through the roof? Is because you're playing this conservative. We're doing this conservative thing because the market is going straight down. So if we had been invested and our RS was going like this, even if we were underneath our 10-day um, on the equity curve, we could still push it. Like it's an
Mhm.
or statement. On the other side, if your equity curve is still going up and trending up, but your RS line is going down, meaning you're just being lifted up because the general market's doing well, but on a relative basis, you're doing poorly. You might want to think about backing away as well. So it can get very involved. I would say anyone who's new to this, I wouldn't make any decisions off of these charts. I would just build these in Excel or Google Sheets or whatever you want to use. Just build it and observe it, and then just notice things. Take journal to yourself or email to yourself, and then as you start seeing things like, oh, really do poorly after this happens, then make some notes. Or I do really well when this happens with my equity curve or my RS, and adjust accordingly. And that's why we have those.
Mhm. So one other thing, I just in kind of closing here, we wanted to go through a few precedents just
Mhm.
to kind of show one of the reasons why, in addition to the chips, kind of being a mixed message, we're doing good on relative strength, but we're below our 10-day. It's worth kind of looking at a few different examples of how volatile things can get around the 200-day moving average line. It's one thing if you just bounce and everything's great, but it's a very different thing when you start getting noisy. And of course, one of the classic examples of a bounce, and I almost wish I could just take the date off here, but a classic example of a bounce off the 200-day moving average line was back here on February 28th, 2020. And for those of you that have already blocked it out of your mind, I mean, this is a great bounce. I mean, it came in real sharply, so that's not great. But you had a nice follow up. I mean, this is a 4.5% move the next day.
And that's
But
should have happened yesterday, like
yeah,
something like that. And that's why we backed away, because we were expecting what happened there to happen at least half of that. Like that would have
right,
been normal. And like this was a little bit extreme on the upside.
yeah.
But a
But it
2%
was also
move,
extreme on the downside.
yeah.
So.
Fair. But at least a 2% move would have been normal and natural.
Right. So, just kind of fast forwarding a little bit through this, you reversed, it's still holding up okay, but then it's not until the 6th where, okay, you now have another bounce off the 200-day moving average line. So again, it doesn't look like this is necessarily going to fall apart at this point, right?
No, it doesn't. I mean, but you also do want to, whenever you look at a chart, you want to think, how did that look at the bottom of the day, right?
Yeah.
Or at the high of the day. And like at the bottom of the day, you're back underneath that 200 day. It's like, wow, the market allowed itself to go from 9,000 all the way back down underneath the 200. It's kind of like our current market, where it's like, wow, they really let them go down that much. Like if the bulls were really in control at that point, they would have been soaking up all those shares and never let it gap down and get that low. But go ahead.
Yeah. And again, it's very important to remember how volatile it was. I mean, these and this is very typical of what happens in a bear market, in a rough market. You'll have some of your best up days, which a lot of people say, well, how could you miss these up days? But you have some of the worst down days too. I mean, look at how ugly this got. And again, this was COVID. When it was just, this was lockdown time. Nobody knew what was going to happen. But we did have that follow through day on April 6th on the NASDAQ. It was actually a little bit earlier on S&P 500. It was April 2nd. But there was a lot more damage after that support at the 200-day moving average line. Not that that's going to happen here, but just having in the back of your mind, it can get worse before it gets better.
Yeah. So the COVID thing was extreme. Obviously, it was a one-off. It's kind of like 1987. You are aware of it to know that, like, okay, when this happens, it could get this ugly, but you know that, okay, it's probably not going to get that ugly, but it could go in that general direction of going well underneath your 200 day, um, like that did. So it's another thing to learn from this, and then we can move on to the other example and call it a day, is if you just wait to get back above that green line, your 21 day, before you really push it hard, um, then you're in a much better position. And certainly if you wait until you start trending back above that 21 day and or the other moving averages, you're in a better position.
Yeah. So I'm looking at some of the comments in the YouTube, and just asking, who's pretty much, I feel like he's always here. So he or she. A nice summary here of raising the point that was made by some other folks about the possibility that this could be kind of a long trudge. And I think that is something that, from the get-go, we were kind of saying, because of the bad break on December 18th, that a lot of times you just need time. You might not go down more, but a lot of times you just need time. And so if we go back to 2010, for those of you that weren't trading back then, just a little history lesson. We had this flash crash on this day in May 2010, where we did get support at the 200-day moving average line, but it was a wild day, right? What was it? Citigroup and some individual stocks went down to like nothing, basically.
That was about
Intraday.
the craziest day I've ever experienced.
Yeah. So you had this kind of exogenous event, came back up to the 50-day moving average line, and then here on the 21st of May in 2010, you did undercut the 200-day moving average line. You did undercut the lows here from the flash crash, but a nice looking reversal on this day.
You know what? I know what happens, and regardless, you've got to take that out of your mind. And I would buy that all day long, from a
Mhm.
swing trading standpoint, because you're go back to it. You know, at that point, that's all the information you have, and you still knowing that it just failed 2 days later. You want to ask yourself, would you buy that? And if your answer is no, then you have to have a reason for it. Is it you want to wait for it to be above your 21 day? Nothing wrong with that. You want to wait for a follow through day? Nothing wrong with that. But if there's some other reason, you're probably fooling yourself, because an upside reversal right around the 200 day, undercutting a key level, that's a buy, and we see how quickly that faded, just like what we had yesterday, where it was telling you that the market wasn't as strong as it looked that day. It was just short covering, most
Mhm.
likely.
Yeah.
You can go
So
forward. Sorry.
fast forwarding a little bit to the 25th, again, we got that undercut and then a move higher. And I'm just going to go a month
Yeah.
out,
Yeah.
um, and it was just kind of above the 200-day moving average line. up to the 21 day, back below the 200 day, up to the 200 and above the 21 day to the 50-day moving average line, back below the 200 day. And it really kind of carried on this way for
A long time.
a little while, until maybe September 1st. And I do remember this was a follow through day right here. So if you had kind of counted this as your day one, a rally, you didn't undercut. And then you got right up to the 21-day moving average line. Now, you might have been a little gun shy because you were under the 200, under the 50-day, under the 21-day, but there was some merchandise. One of the stocks that I think everyone and their brother was and sister was buying on this day was Chipotle Mexican Grill. I was buying it on this day, coming out of this beautiful cup with handle. I think Netflix was another one that had this little double bottom, broke out, kind of just came back to the pivot, and then really took off from here. But yeah, this was a follow through day.
Can you do
And
me a favor?
yeah,
Can you go back to CMG?
yeah.
This is probably one of the most beautiful bases of all of history, and I'm not joking. And I think people should just make a note of this: September 1st, 2010, and study CMG daily and weekly. There's so much you can learn from that particular one. I mean, we could talk about it for 3 hours. It is like really, really special, important stock. And now let's go back to the market. At that point, the NASDAQ. So you had your follow through day, and the rule is you buy something on a follow through day regardless. And so you could either bought the Qs, or you could have bought the CMG or the Netflix or a bunch of other things out there. Then it's like what happens afterwards is really, because which everyone, if you're new to the system, you got to remember about half of the follow through days, depending on how you slice, what
Mhm.
is successful or not, are going to fail. Like that just comes with the territory. It doesn't mean you don't use them. They work really, really well, and it's a core part of what we do. But it doesn't mean that they're all going to work. And so you go in there and you have to have your exit strategy. So as good as CMG looked, or as good as Netflix looked, you would have said, okay, well, if it does this, if it comes into this level, you're going to back away from it. And then the other
Or on
thing,
the flip side, if it does these positive things, you're
get
going to
out of it.
start increasing, right? Because we don't go all in just because we have a follow through day, but those elements, like you've said a number of times, hey, if you can get above the 21-day moving average line for 3 days, or whatever the closest moving average line is at the time, hey, that's something. And we
Right
did
there.
that pretty
Yeah.
quickly after this one.
Yeah, so 3 days with your low above it and closing up on the day was the day before, and you also are above your 50 day. Now you're above your 200. Okay, boom, right there. That you had 3 days where your low was above the 21 day, and I mean was above the 200 day. You'd already been living above your 21 and your 50, and you take out those marked highs, the 2309, uh, the most recent marked high. You're gunning it hard there, because that's what you should, regardless of how it plays out, whether it goes straight up or collapses. You just want to look and say, okay, given that same setup, what would you do? And you gun it.
Yeah. So we have Gretchen in the YouTube comments that said that
Hi, Gretchen.
yeah, so she was saying that she bought both Chipotle and Netflix on those days, and they ended up buying a vacation home in Lake Tahoe with the proceeds from Netflix, that Netflix trade, and they call it the house that Netflix bought. So that's awesome, Gretchen.
That's the best story. And so
That's very cool.
you're inviting Justin, Dominic,
Yeah,
and
that,
over.
that, that, that's the way I took that.
I that's how I took it. Yeah.
Yeah. So, but look,
I always
again,
wanted the Godfather the house there. Wasn't the Godfather 2 house there in Tahoe?
oh, I don't know. That's
Pretty sure.
I'll have
Yeah.
to look that one up. But some other folks in the comments are talking about whether or not to go get their short positions ready, inverse ETFs ready. And one of
No.
the things you have to be careful of is that sometimes, again, you get this noise around the moving average lines. And look, we've gotten a lot of headlines, that have kind of tossed the market to and fro, and that can be very difficult, because as soon as you start going one way, the market goes the other. And you could just end up in a little bit of a chop fest. And choppy markets are just notoriously difficult to play. You can end up losing on both sides. You lose when you go long, you lose when you go short, and then you turn around and say, how did I lose all that money? When the market was flat, basically.
Yeah,
So,
and then the worst thing is you don't want to lose your confidence,
yeah.
because if you lose your confidence, and it happens to all traders, and there's not one trader, including myself, that doesn't lose their confidence all the time. I've seen it. Some people hide it better than others, and then what happens is you hesitate a little bit too long to buy, or you hesitate a little bit too long to sell, and it snowballs on itself. So one of the things you want to do, and we can go back to the current market, is you want to stay loose and don't be fearful to put on a trade. And that's why sometimes you'll see us, we'll put on a trade here or there for a little bit, and then it doesn't work out, we back away, because there's a benefit to staying loose. And even if you go into it knowing, yeah, you're probably going to lose, but you calculate your risk and say, okay, I'm willing to give up this many chips to get that feedback from the market and say, oh yeah,
Mhm.
that stove is still hot. Because you don't want to be like, oh no, I can't trade because the last 5 trades were all losers. Well, the last 5 trades were losers, and that's telling you something about either the market, how you're trading, what type style that you're using in that market. And then you either adjust or just go, well, you know what? You go back to each one and you say, would I do that trade again? And if the answer is yes, then you did nothing wrong. And if you're honest with yourself and say, no, you know what? I just messed that one up.
Mhm.
Then you're like, okay, I learned from that. What rule could I write down? Okay, I shouldn't buy extended stocks, or I shouldn't buy like short in this position, because we're down. The only the way a short is going to work out right now on like an index level um, is going to be if we crater, like
Yeah.
if something happens overnight and we go into a free fall, well, that's going to work. But most likely, even though we don't like to say the words like oversold, you're more likely to bounce from here than
Mhm.
take another leg down. But that doesn't mean that we're going to bounce from here, and that's why we don't have any positions on. But it is really going to be, you know, how does the market interpret what is happening in DC? That's really what the market is about. Like before, it was about the Fed, and now kind of the Fed is really dictated. What they're going to do is dictated by what the economy is going to do, and the economy is dictated by kind of what is happening out of DC. And so take whatever, half the people voted one way, half the people voted the other way, and some people probably didn't vote at all. Forget all of that. Like forget your political bias and just think about it from a market standpoint. Go, okay, how is the market interpreting the news that's coming out? Is it good or bad? And is it good for this industry, bad for this other industry? And trade accordingly. But stay loose out there. And I've told this before. There was a time when it was a terrible market environment. I don't remember when. Maybe you do. But Bill had all of the PMs had us all at 1% invested max,
Mhm.
like our entire account. And I don't remember how long that was for, but um, but it still allowed you to get a feel. Like even if you're only trading with 1% of your account, you at least got a feel. So the last thing that we'll say, and then I think we can wrap it up, is while we're underneath our 10-day, as a general rule, we'll change this based on conditions. When our equity curve is underneath our 10-day, we'll probably start off positions with a half size position, unless they're ETFs, and ETFs probably go full. And then when we're back above it on a closing basis, our starting positions will be full. Now, in theory, you could do that even more. Like if you're underneath the 21-day, then you do quarter positions. Well, we're probably not going to do that because we want to try to keep this product as simple as possible. But at home, you could do that. You could say, hey, your 10 days underneath your 21-day of your equity curve, you're going to start with 1% positions. There's nothing wrong with that. Just experiment out with it. But the key is keep your confidence. Don't get chopped up too bad. And, do a lot of homework. This is the time to do homework, meaning get your watch list ready. And that's what we're both doing. All three of us are doing, all day long, every day.
Mhm. And as a reminder, a lot of what we're talking about in terms of what we are doing is on the product, the SwingTrader product. So, we chat with you guys every week, and of course, sometimes we go longer than others, like today. But
Oh, sorry, man.
one of those situations where there's a lot to talk about. Seems like there is every week, but on SwingTrader, you will be able to kind of keep track of when we are putting things on, taking things off, when we are doing those test buys. Because we do send alerts, throughout the day, and kind of explain what we're doing, and then also a market action wrap up at the end of the day, which I will get to as soon as we're done with this. So thank you a lot for joining us. Thanks, Mike, for your commentary. And if we don't have any trades to do, we'll probably next week talk a little bit more about precedents and things to kind of learn from history. We went through a lot of history today, and nothing wrong with doing that in your downtime when you're not trading as much. So very useful exercise. But thanks again, Mike. And thank you, everyone, especially for those of you that are in the YouTube comments. Had some great ones in there. Appreciate everyone that was hitting like and also subscribe. You can also get this, join us live every Tuesday. We go live at 5 p.m. Eastern, 2 p.m. Pacific, and we love engaging with you. So thanks a lot for showing up, and we'll see you next week. Take care, everybody.